It's over.
It's the final countdown.
No, not the bull market. Quantitative tightening. The Fed's about to flip the switch and unleash quantitative easing. Well, maybe not, they're going to call it QE, but some kind of liquidity injections. Last time they did this, Bitcoin didn't just rally, it melted faces, stocks, gold, altcoins, everything went vertical. I know you're tired. I know you're exhausted from this bullshit cycle, but stick around because this one might just change your mood. Look, this isn't something new either. The idea of flooding the system with liquidity to stabilize markets has been around for decades. It's basically what the Fed does. Former Fed Chair Alan Greenspan set the stage. He wasn't calling it quantitative easing yet. Whenever the markets wobbled, the Fed would step in and inject cash. They have lots of different sneaky ways of doing this, going beyond quantitative easing as well. They can do lots of different levers in the background that'll inject liquidity in the market. The safety net for markets became the foundation of the modern market behavior. Then came Fed Chair Ben Bernanke. Bernanke, the bank man. Anyway, back during the 2008 crisis, he made it official. QE was born. Print money, buy bonds, rescue the system. From that moment on, the market learned one thing. Liquidity is like duct tape. It fixes everything. QT, QE, two letters that pretty much decide whether markets feel rich or wrecked. But what exactly are they? Well, quantitative easing, QE, is when the Fed basically hits the money printing button, and then they buy bonds and flood the system with cash. Risk assets go into absolute bonkers mode, and suddenly everybody's out there, flashing their Rolexes and picking colors out for their Bugattis again, okay? QT is very much the opposite of that, okay? Quantitative tightening is the cold shower that follows because the Fed basically engineers boom-bust cycles via their policies. The problem with a booming market is that it gets too hot, inflation starts running wild because everybody starts getting fucking rich and buying everything, so the Fed steps back in, they let bonds expire, and they start sucking liquidity out of the system. They run off their balance sheet, which is quantitative tightening. So instead of buying bonds off the market, they just let them run off. Credit tightens, prices cool, and the dream of retiring your bloodline goes back with you to the burger shop. Sorry. We've seen this pattern for well over a decade now. After the 2008 crash, the Fed launched multiple rounds of QE, injecting trillions of dollars and slashing interest rates down to zero, which drove an unprecedented bull run. Then in 2019, as the Federal Reserve tried to shrink its balance sheet, guess what? Liquidity dried up and the overnight repo markets nearly seized, forcing emergency interventions that quickly resembled QE again. Although those were not officially QE. They were overnight repo bailouts, okay? Got to watch out your terminology here. By early 2020, with COVID looming, they doubled down and actually started doing QE, fueling the dramatic melt-up that followed. Fast forward to 2022, the regime changed. Inflation hit generational highs. The Fed pivoted to an aggressive schedule of quantitative tightening and rate hikes. Risk assets saw sharp drawdowns as a direct result of these swings in policy and liquidity. So every time the Fed tightens, something breaks. Every time they ease, asset moons. So, same movie, okay? Just with bigger numbers every time and a higher budget each time because it's the only real solution they have. And what's happening right now? We got an interesting plot twist here for you. Before we get to that, guys, if you're trading Bitcoin, Ethereum, Solana, whatever, you get yourselves an account over on BitUnix, where I do a lot of my futures trading these days, and they have an insane deal on right now. Of course, you can long the rips, short the dips, available to anyone, anywhere. That's you. Put in 10,000 bucks, you're gonna get $1,000 back. Put in 20,000 bucks, you get $2,000 back. Put in 50,000, they're giving back 5,000, and for an insane whale bonus. So if you have $100,000, you want to come over and start trading, they're gonna give you $10,000 cash back money. That's a freaking crazy deal, man. Wildest bonus I've seen from any exchange in a long time. By the way, when you use the link down below to start your account, you also go straight to VIP level 3. It means you're going to get some sweet fee discounts as well. Go check it out. Link down below. Very limited time offer, by the way, so go get it. All right, go. So we're at the part where the plot twists again. Our Fed overlords just said they're ending the drawdown of their $6.6 trillion balance sheet. Basically, QT is done, starting December 1st. Why is that the case? Because liquidity in money markets is starting to dry up and bank reserves are falling. In plain English, the system is running low on fuel. What's that even mean? Well, let's break it down. Every month, around $40 billion in bonds hit maturity. The Treasury pays the Fed when that happens. Just wire the cash over, man. And for the last 3 years, during the quantitative tightening cycle, the Fed's been just burning that money, essentially. They don't reinvest it back into bonds. They let the bonds just expire without buying more back. It's like sending tokens to a dead wallet, kind of, in crypto terms. Anyway, that cash just kind of vanishes from circulation, which starves the market of liquidity. Now, here's the big shift. Starting in December, when those bonds mature, the Fed isn't going to be just letting them run out anymore. They're not going to burn the cash anymore. They're going to start reinvesting it back into new bonds, rolling them over instead of letting them roll off. That changes everything. Because even though the Fed is not formally announcing a new QE program, it's not the same, all right? Ending QT does not inherently mean starting QE. But it certainly changes the dynamics of liquidity within the market. And you have to understand that in terms of risk on, risk off attitudes in the market, we have had a monumental rally in stocks and crypto despite tight financial conditions, with rates high and quantitative tightening going on. Pretty soon, they're ending QT and they're cutting rates more, which sets us up for an even more bullish risk on atmosphere, okay? But make no mistake, when you stop draining liquidity from the market and start recycling back into the system, that is kind of a stealth QE. It's easing without admitting it. When the Fed starts buying again, demand for bonds goes up, and when demand rises, bond prices climb. So that $1,000 bond paying a fixed $50 interest now trades for $1,100, same $50 coupon, but now the lower effective yield is under 5%. That drop in yield pushes investors to look elsewhere. What do they start looking into? Riskier, higher yielding assets, stocks, Bitcoin, all that kind of stuff. Over $7 trillion right now sitting in money market funds that'll start budging when the rates get cut to 1% by Trump's new Fed chair in May. Now, before you call us all just some random bullshit hopium, let's go back to the pandemic era. After COVID hit, the Fed knew the economy was in deep trouble. So what did they do? They launched a $700 billion QE program. They slashed interest rates to zero. That wave of liquidity, that wave of money, it didn't just save the markets, it supercharged them to the max. The S&P 500 ripped over 2,000 points from March 2022 to December 2021. Bitcoin went absolutely bonkers. It melted faces, up more than 1,400% by the end of 2021. Those are big numbers. Of course, the party ended when the Fed flipped the switch. QT started in June 2022, liquidity started drying up, and that's when the bear market truly hit. Now, prices were already down dramatically by that point, but when the rate hikes started going, the QT came in, it was over, okay? That was the final nail in the coffin. So look, QE and QT aren't just abstract policy tools. They're the on-off switch for the market life support, and right now we're seeing the regime change, much like we did in 2022 when they started tightening by hiking rates and going to QT. We're seeing a massive regime change back in the opposite direction where rates are being cut and QT's ending, with the door open for more liquidity injections in the future. So how will this play out? Look, I know everyone's on edge right now in the markets because if this cycle's really over, it was the lamest one ever, okay? But it doesn't fit with the macro picture and what the Fed's doing, okay? The Fed's easing. QT's ending. QT will begin at some point in the not-so-distant future, or even stealth QE. Rate cuts are coming. This is a regime change that should send assets up, not down. Maybe we'll even get that third rate hike in December. When it comes to Bitcoin and risk assets, it's not just about interest rates. Sure, they matter. Yes, obviously. The real story is liquidity, baby. Rates are just the headline. Liquidity is the bloodstream. And when QT ends, reserves stop being run off, that liquidity doesn't just sit still. It moves, and it moves first into risk assets. And yeah, it doesn't go into dog coins first, but it does move into risk assets. And the more money gets made in risk assets, the more money starts pouring down the risk profile, okay? That's where reflexivity kicks in. Liquidity stabilizes, prices rise, collateral values improve, credit spreads tighten, lending expands, boom. The cycle feeds itself. Until it doesn't, we have a horrific crash, which always comes. But the way conditions are right now don't support that to happen very, very soon. And Bitcoin, of course, the purest mirror of that flow, highly reflexive to changes in liquidity in the system. It's got no earnings reports, no PE ratios, no corporate buybacks. Our digital asset treasury companies have corporate buybacks? Kind of, sort of, not really. Anyway, just global liquidity, reflected tick by tick. We've seen what happens when the Fed opens the tap. Case in point, the post-COVID QE sent Bitcoin up to $69,000. This time the setup's even bigger. The Fed's balance sheet is larger. The debt is heavier. Interest costs are doubled. All of which means that when liquidity turns, and it will, especially once the government is all reopened and all that shit's going again, the impact on risk assets could be absolutely explosive. Look, the QT regime was brutal, yet both stocks and Bitcoin still made new highs, even in spite of that. Now imagine what happens when the Fed turns the tap back on. Think about it. Is it more likely that we're going to start a new major bear market just as we go into the loosest financial conditions we've seen in years? Or is it more likely that shit's going to get real crazy out there? Because when the Fed floods the system with liquidity, the same thing happens every time. Markets melt up, disbelief fades, everyone thinks they're fucking geniuses again, the cycle resets. So yeah, maybe it's hopium. We all need a good bit of hopium once in a while, but history says it's profitable hopium. Okay? And by the way, before I go, guys, you gotta check out our newsletter. It's free, it's awesome. There's a link down below. Macro, crypto, stocks, Bitcoin, trading setups, and more. It's free. Link down below. Go check it out. Thank you very much.